Imagine waking up, walking to your kitchen, and realizing the numbers in your bank account haven't changed, but they are suddenly useless. You look at your phone, the balance says $50,000, but outside, that $50,000 can no longer buy you a simple loaf of bread. This is not a scene from a post-apocalyptic movie. It is the documented reality of an economic crash. Most people think a crash is just a bad day on Wall Street, where stocks dip 20% and you just buy the dip. But that is a recession, a temporary hiccup in a growing system. What I'm talking about today is a total purchasing power annihilation. The kind of crash that rewrites the rules of money overnight, the kind where the exit doors are welded shut before you even smell the smoke. By the end of this video, you will know the 5 specific assets that do not just dip, they vaporize. I have performed a financial autopsy on the collapses of Argentina, Greece, Lebanon, and the Weimar Republic. And what I found is a terrifying pattern that most investors are ignoring right now. Let us start with the first asset, the one people buy when they want to feel successful: luxury durable goods. I am talking about your high-end German SUVs, your collection of Swiss watches, and those rare sneakers sitting in your closet. In a booming economy, these objects are seen as stores of value, but the moment a real crisis hits, they turn into heavy anchors that drag you to the bottom of the ocean. Here is the psychological trap. Luxury goods derive their value from 2 things: extra spending money and social status. In a crash, both of those things vanish instantly. When the world is ending, nobody cares about the logo on your wrist. They care about the food in your pantry. Look at the 2001 collapse in Argentina, the largest sovereign debt default in history at the time. Before the crash, a used BMW in Buenos Aires held its value perfectly. But within 6 months of the collapse, those same luxury cars were being traded for 20 cents on the dollar. And here is the knife twist. You could not even sell them for the local currency because the currency was dying. You could not sell them for dollars because nobody had dollars left. So these $60,000 machines just sat in driveways, rotting. Oh, while the owners still had to pay taxes and insurance they could no longer afford. But this is where it gets shocking. It is not just the flashy toys that fail. It is the very thing your financial advisor told you was the safest investment on earth: government bonds. If you have a retirement account, you likely own these right now. The industry calls them risk-free assets. But let me tell you a secret. There is no such thing as a risk-free asset. A government bond is simply a loan you give to the state, and that state promises to pay you back in their own currency. But what happens when the government decides to print 10 trillion more of that currency? Your safe bond becomes a piece of paper that represents a fraction of what it used to buy. In 2012, Greece performed a restructuring, which is just a fancy word for a forced haircut. Retirees and small investors who held Greek bonds lost 53% of their wealth overnight. One day they were set for life. The next day, half of their life savings was gone by government decree. And if you think that only happens in small countries, look at the United States after World War II. The government kept interest rates way below inflation for over a decade. If you held a bond, you got all your money back. But that money had lost 1/3 of its purchasing power. The government didn't steal your money. They just made the money worth less while you were holding it. It is a silent, invisible default, and it is happening again right now. Now, if bonds are the silent killer, the next asset is the one everyone thinks they understand: cash. We have all heard the phrase, cash is king. But history shows us that cash is only king until the kingdom itself falls. In a normal world, cash is great for liquidity. But in a currency crisis, cash is a melting ice cube in a desert. Take a look at Lebanon in 2019. For 22 years, the Lebanese pound was stable. People trusted the banks. Then the system snapped. A family that had saved $100,000 worth of pounds for their children's education saw that value drop to just $1,600. The numbers on their bank statement stayed the same, but the value evaporated into thin air. This is the ultimate betrayal. People who did the right thing by saving were the ones who were punished the most. In Venezuela, the currency lost 99% of its value in a single year. Workers were being paid twice a day because if they waited until the evening to go to the store, the prices would have doubled. Imagine running to the grocery store during your lunch break because your morning wages won't buy a loaf of bread by 5 p.m. And what happened next, nobody expected. The destruction doesn't stop with cash. It moves into the stock market. But it targets one specific group of stocks with a vengeance: speculative growth stocks. These are the companies with no profits, no dividends, and no real products, just big dreams and future potential. During the 2008 financial crisis, over 400 public companies in the U.S. went bankrupt. Names like Lehman Brothers, which had $600 billion in assets, were wiped out completely. When the easy money stops flowing, these companies die instantly. They are like castles built on clouds. They look beautiful when the sun is out, but the moment the wind blows, there is nothing underneath to hold them up. In the Greek crash, the stock market fell 92%. An investor with 100,000 euros ended up with 8,000, and that was if they were lucky. Many companies were simply delisted, making the shares worth exactly zero. If a company depends on cheap debt to survive, it will not survive a real crash. But we have saved the biggest wealth destroyer for last. This is the one that hits the middle class the hardest because it involves the American dream: leveraged real estate. Now, stay with me here. Real estate can be a great asset, but only if you own it. If you have a massive mortgage, you do not own that house. The bank owns it, and you are just a tenant who is responsible for the repairs. In a crash, property values can fall 40, 50, or 60%. But your mortgage does not move an inch. If you owe $400,000 on a house that is now worth $200,000, you are in a financial prison. You cannot sell it because you would have to pay the bank $200,000 just to leave. You cannot refinance it because the collateral is gone. In 2008, nearly 4 million families in the U.S. lost their homes to foreclosure. But in places like Spain, the law was even more brutal. Losing your house didn't mean your debt was gone. Families were kicked out of their homes and still owed the bank hundreds of thousands of dollars for a property they no longer lived in. This one detail changed everything. Leverage is a tool that works wonders on the way up, but it acts as a guillotine on the way down. If you have 10% down on a house and the price drops 10%, you have lost 100% of your investment. The math of a crash is unforgiving, and it doesn't care about your feelings or your dream home. So, let us look at the map of the minefield we just walked through. 1. Luxury goods, because they have no utility when people are starving. 2. Government bonds, because the state will always protect itself by devaluing your debt. 3. Cash. Because it is a ticket to a show that the government can cancel at any time. 4. Speculative stocks, because dreams don't pay the bills when the credit dries up. 5. Leveraged real estate, because debt is a trap when values fall. Every one of these assets feels safe right now, and that is exactly why they are so dangerous. Safety is not a permanent feature. It is a reflection of the environment. A life jacket is a safety device on a boat, but it is just heavy, useless foam when you are trying to run through a forest fire. The global economy is currently carrying over $300 trillion in debt. The interest payments alone are now costing more than the entire military budget. The warning lights are not just flickering, they are screaming. From Argentina to Lebanon, the story is always the same. The people who survived were the ones who saw the crash coming and moved out of these 5 death trap assets before the doors locked. If this story shocked you as much as it shocked me, hit that like button. It helps the algorithm show this to more people before it is too late. Comment below. Which of these 5 assets are you most worried about holding right now? I want to hear your thoughts. My next video drops this Sunday, and it covers the only 5 assets that have actually survived every single crash since 1923. I perform these financial autopsies so you don't have to become the next case study. Remember, history has all the answers. You just have to be willing to listen. I will see you in the next one.